has made our city so unique. Now we just roll over for the latest policy, which essentially is rent control, which was voted against, by the people, but we're hiding it under these other auspices. And I think it's very unfortunate, that we've gotten to the point, and I think unfortunately for people like myself that just want to live their lives in Huntington Beach, we can no longer do that. 13,000 plus high density housing is very contrary to running against voting or opposing, if you will, high density. So we get down to this path to where we are today. Thank you for your time.
Do we have any other public speakers in the room that would like to speak? The attendees in the waiting room, does anyone have a public comment? Please dial *9, which will raise your hand so that I can call your name for public comment. And we received an email at 4:32 today addressed to the City Council, and it is from Dennis Pappas. The memo is titled Finance Committee Statement from HB resident Patricia Pappas, Fullerton College Limited Faculty. It's addressed to the Finance Committee, Oliver Sheehan, Huntington Beach City Council, dated September 28, 2021. I'm pleased to send a statement to be read at the Finance Committee meeting this evening, Tuesday, September 28, 2021. I'm very displeased to stress that our HB City Council has approved the bond to purchase 2 properties on Huntington Beach to use that eligibility, and that goes to citizens in Huntington Beach. As faculty member at Fullerton College in North Orange County, I observed many bonds and elections attached over the years. Citizens voted and made choices on their willingness to add costs and taxes to their households. Each of these bonds had a citizens oversight committee attached. North Orange County views an ethical and responsible approach approved by voters. Huntington Beach City Council has demonstrated blatant unethical behavior by approving the purchase of the Elan and Breakwater properties. City Council has excluded the HB citizens in the dialogue. HB residents are responsible to pay for these unwarranted and unapproved projects. Patricia Pappas.
Is there a chance you could speak up a little louder? I'm having trouble hearing you.
There's a lot of noise coming from the other room.
I don't mean to be rude, but it'd be helpful.
Caller with the last number is 851. Let me start this caller. Can you hear us, caller, with the last 3 of 851? Here we go. Can you hear us? Hello. Go ahead, ma'am.
Hi, my name is Melody Stillman, and I have a residence in the city of Huntington Beach since 1992. I want to say I agree totally with the very first speaker. I'm totally against high density housing in Huntington Beach. It will literally change the landscape of our beach city overnight if you allow high density housing in Huntington Beach. Thank you.
Thank you. Do we have any other public speakers in the waiting room on our call?
All right. Okay, at this time we need to get an approval of the minutes from July 28th meeting.
Okay.
And can we get a second?
Okay.
All in favor? All right, the next item on the agenda is middle income housing program, and we have a speaker tonight.
Thank you. It's so nice to see so many people at a Finance Commission meeting. Usually it's just the Finance Commissioners and staff. Tonight we're going to provide an overview for the Finance Commission for the Finance Commission's request on the middle income housing program that the city approved back in July of this year. With me here tonight is Ursula Reyes, our Community Development Director. I've heard a couple of different comments about what the city did or didn't do. We're hoping to be able to articulate what the policy decision that the council made regarding this program, what that actually was, and also provide some mechanics related to what the program actually is. The city actually didn't directly go and acquire. I heard a lot of comments tonight about the city acquired the 2 apartment units, Elan and Breakwater. The city actually joined a joint powers authority. The joint powers authority is the one that went and actually acquired the units.
Yeah, right.
We understand.
But the city is part of multiple joint powers authorities.
It's in our city.
That's how you hide your purchases,
It's in
joint
our
powers
city.
authority.
It's not in a joint power city.
Oliver.
Oliver, who are the other members? It's a straw man. Could you maybe highlight that for us?
We will
It's corruption. Wait, let
Everyone
me
can
speak.
certainly have their opinion about the policy decision that was made. What the staff is here tonight to do is provide an overview to the Finance Commission related to what the mechanics are related to this overall effort. We have a presentation that we're going to run through to hopefully answer some of the questions that have been raised tonight. If the Finance Commission has any questions as we're running through it, please feel free to let us know. We're happy to have this discussion. Ultimately, the thing I will emphasize for the Finance Commission, JPAs are set up specifically so that when the city becomes part of a JPA, we have no legal liability or oversight control of that entity outside of what's in the formation documents. So we are part of multiple joint powers authorities. Whatever we think about that, the fact is we are part of the sanitation district, for example, or Orange County Power Authority. We're part of the California Municipal Finance Authority, which was the entity here that was utilized to acquire the 2 properties in question. And we're happy tonight to be able to share again some of the mechanics related to what it is, and moving ahead, really what the implications for the city are. So with that, we'll let Ursula kind of run through the mechanics, and then we'll be happy to entertain any questions the Finance Commission has.
Thank you, and just going to get pulling up the PowerPoint, so unfortunately I'm not sure how well it will be seen on the screen, but hopefully folks can see it. And
Ursula, before you start, I just got conflicting information here. You, Oliver, said, essentially asked questions during the presentation, and then you said after the presentation is over, ask questions. Are you going to be taking questions during the presentation?
Yes, if you have questions during the
Very-
meeting, that's fine,
yeah.
yeah, no problem. And so I appreciate the interest in this topic, and hopefully we can clarify some things for some folks. So this very first slide shows some pictures of some nurses, plumbers, teachers, etc., who would have a difficult time affording market rate housing here in Huntington Beach. So the program, this middle income housing program, is meant to target sort of these sorts of workers, these vocations, to provide some housing opportunities here in Huntington Beach that might be a little bit more accessible to some of these folks. And I'm actually having conversations with a company here in town that is having a really hard time attracting workers to his business. The average age of his workforce is 70 years old. And the big reason that he's having trouble attracting new workers is because of the housing costs. That's what has been communicated to us. And in fact, he's probably going to have to shut down this business. It's one of the larger sales tax generators here in the city of Huntington Beach. So it is, revenue that potentially will be lost to the city if he does shut down his business. And his workforce, either the ones that do live here locally, they purchased so long ago, that's how they're able to afford to be here. But the majority of the workforce actually travels quite a distance to be able to work here in Huntington Beach.
Ursula,
Yes.
in your opening statement, you mentioned teachers, firemen, plumbers. In the February meeting, Mayor Carr had asked if we could limit the type of individual that would be able to rent at these lower prices. And she mentioned teachers, firemen, policemen, and nurses. She did not mention plumbers. Are plumbers now been included in that list?
So actually, when the item was approved by the city council, they approved an ad hoc committee to discuss what kind of parameters they wanted to put around this program. And they decided, and it came back to the full council, that they didn't actually want to put any kinds of parameters. So this program now is available to anybody who can come qualified, with a preference on people who live and work in Huntington Beach.
That's the only preference?
Correct.
Okay.
Yes. Okay.
I have a quick question.
Sure, CJ, go ahead.
Or did I go keep discriminating? Yeah. When you say preference, for me a little bit more, just to kind of understand how we're trying to keep people here that want to be here as far as that's concerned, that would be a little bit more on that would be great.
I think I understand the question. I'm having a little bit difficulty hearing, but so the preference is, so there's some fair housing laws that are in place where we cannot, it's why it's a preference as opposed to a absolute requirement. But the way it works is that there will be some waiting lists to get into these properties. And if you live already in Huntington Beach and or your business address is in Huntington Beach, you will get preference, which means you'll be moved up to the top of that list. So if there's a total of, I'm just going to throw out a number of 500 units that are available, the first 500 will go to people, if there's people on the list that live or work in Huntington Beach, all 500 would go to those folks. If there's only 300, then it would be open to 200 people that could live or work outside of Huntington Beach, but they would have to income qualify. And I will later share the income levels.
I have a question. What about people that work at home?
Yeah, well, they would qualify. They live in Huntington Beach, so yes.
But they don't live in Huntington Beach today.
Oh, they
live
work.
in Huntington Beach if they got the apartment.
So they work from home outside of Huntington Beach. They would not. They wouldn't fit the preference. No.
Even if they work for a company that's in Huntington Beach?
That doesn't sound legal.
Okay, so if the company, I understand under today's days with the telecommuting, yes, if their company is located in Huntington Beach, they would qualify for the preference. I guess I was thinking of like a self-employed individual, like maybe an accountant who works as a home occupation business. If their home occupation business and home was outside of Huntington Beach, they would not qualify for the preference. Good clarification. Okay, so I guess the point is just that this challenge is a threat, not just to the city of Huntington Beach from a housing perspective, but from an economic development perspective as well. Next slide, please.
So are you approaching this problem as a economic development issue primarily then?
I think it has equal policy implications, and I'm not sure that the city council really had one preferred over the other, but the program, I think, meets objectives under both of those policies.
This hypothetical company you're talking about, have you spoken with them after you presented this program to them? Have you presented the program to this company?
Not yet. We just received some of the marketing brochures for the units, and we will be.
Do you happen to know
We're
what?
planning.
I'm sorry.
We're planning on distributing those to employers in town as well as real estate agents in town who have clients that are looking for housing.
Do you know the differential in the housing cost between what his employees are experiencing now versus the cost of
I don't.
Elan?
Excuse me,
So
you guys had your turn to speak, and we need to.
We didn't, we were locked out, but that's okay.
Thank you. So this slide covers that in January, the city council held a strategic planning session where they identified some goals and priorities that they had for a work plan, and one of those was housing, and specifically an interest in creating a continuum of housing options in Huntington Beach. And since that time, a number of accomplishments have been achieved, and one is a homeless shelter, which is really at the low end of that continuum. These are folks that might not have any income at all. They're essentially in poverty, and they make less than 30% of the average median income for Orange County. And then there's permanent supportive housing, and this targets seniors and those with income less than 60% AMI or average median income. And that is a project that has been approved for Jamboree. So there is a project actually in the works on the financing side, and they are getting ready to start construction early next year. That will be targeted for seniors at this extremely low income level. There's low income housing that's less than 80% AMI, and there's this workforce housing or this middle income housing, and this is for properties at 80% AMI or above. And I showed some pictures for each of those. You can see a picture of the shelter, and you can see some actual projects in town that meet those income levels. And the one for the workforce housing was the Bella Terra residential project, where not the entire project is workforce housing, but a number of the units were required to be restricted at workforce housing levels. Next slide, please. So this idea of middle income housing being financed with the central government bonds. What is that? What does it really mean? How can someone purchase an existing property and charge discounted rents and compete in the marketplace? Those were all questions that we had as staff as this kind of idea was presented to us. And we were aware that a number of other cities have approved these types of projects. It's how we became aware of it. And but we had a lot of questions, and we spent a lot of time really diving into this and trying to understand it. And so at a high level, there's a government entity through a joint power authority, which Oliver's already talked about. That joint power authority is a tax exempt entity and therefore does not have to pay property taxes. The JPA is able to issue tax exempt bonds, which is a relatively inexpensive debt compared to taxable bonds, and is able to offer, therefore, because of that, the buyer is able to offer fair market value to purchase the asset. So this property, it's not that these properties were discounted to the JPA. The JPA paid fair market value and was then able to leverage the asset through the bonds, the tax abatement. So and that's how they were able to discount the rent and put in a significant amount of reserves. So these projects have a significant amount of reserves in case something terrible was to happen. That was really conservative underwriting, and it was important for us to understand that, and to make sure that the property can be maintained through the life of the bonds. That was also very important, was that we wanted to make sure that these assets are continually being reinvested in so that they look nice and that they don't depreciate terribly through the lifespan.
Ursula?
Yes.
So as I understand this, there were two bonds taken out for each property. One to buy the property, and then one to do what you're just saying right now, which is to create a reserve for maintenance, correct? That's what the second bond is.
Well, there's an A bond and a B bond.
Right.
And the B bond, though, is actually a little bit different. My understanding is that the A bond actually covers the acquisition,
right,
the maintenance, all of that is in the A bond. The B bond is basically a paper bond, and it is not until after the A bond is paid off is the B bond worth anything. And so that is a form of compensation at that end, and it's in there to keep the sponsor of the project performing through the life of the bond, so that they get paid. They do get paid a bit upfront. There's a fee that they get through the A bond, but that B bond is really there to encourage them to be a good sponsor / caretaker of the property through the term of the.
Okay, I'm a little confused then. I've got a copy here of the project debt service payment schedule for Breakwater, and I've got the A bond and they call it A2, A1 and A2. These are the one we're talking about.
Well, those are both part of the A bond that I'm talking about. Those are both part of that. So there's also a separate B bond.
So there's a third bond. I've got A1 and A2 over here. And there's a third bond?
There's an A bond and a B bond.
Okay, I'm looking at the payment schedule. I've got senior bond A-1. And then I've got junior bond A-2. That's two bonds. Is that the two we're talking about?
don't have that in front of me, so
If we want to get into a discussion.
No, I'm just curious, because I just want to make sure that the bonds, I want to know which bond is paying for maintenance. The A1, the A2?
I can get back to you on that.
You can get, at a future commission meeting, we can have the finance describe the actual technical structure. My understanding though is that a portion of the bond proceeds from the A bond are set aside in the reserve account, different amounts for each level, for each of the projects, and those reserve amounts are used to fund initial improvements. Then as the project moves ahead, there's also reserve amounts that need to be set aside on a per unit basis for each of the different properties.
Okay, the Breakwater Purchase is how much?
185 million.
185 million. Okay, so I've got,
Traditionally, if this was the city issuing the bonds, we would be much more embedded in the details. This is the Joint Powers Authority that's responsible for everything.
I understand, but still, the question is, I've got 138 million on A1 and 81 million on A2, which comes up to 199 million, $200 million. That's just for the purchase? I thought the purchase was $1 million.
So the actual purchase of the building itself was 185. There's additional that were taken out for improvements, for underwriting costs. The additional proceeds are set aside in a reserve account. So there's a portion.
So the real purchase price is closer to 200 million for this property?
No, the purchase price is 185 million. The amount of money that the Joint Powers Authority took out was greater than that, so that a project sponsor could invest some money into initial improvements upon acquisition of the building, in addition to setting aside money in reserve accounts.
So then I was right then by assuming that these two bonds together pay for the building and include maintenance, what you call the reserve for maintenance.
In terms of how it's technically set up, we can get back to you and the Finance Commission. But together, the total proceeds were used for purchasing the property, for underwriting costs, for initial improvements to the facility, for ongoing maintenance related set aside costs.
That's these two, A1 and A2.
For each of, my understanding is that we can get the finance folks to come back for each of the projects. There is an A1 and an A2 for each of the different.
And then the third bond, what did I need to know this? And there's a third bond that pays,
There's a D bond, that is a much, much smaller amount, I think
and that's the incentive bond, essentially. Okay, thank you. That's all.
And like, for example, the reserves are set that if this, in general, there was a vacancy for 50% occupancy, so like half of the building was vacant for 4 years, there's sufficient amount in reserves to be able to cover that. We wanted to understand, like, what if this property went into foreclosure, like, so that's really pretty conservative underwriting.
Why would we care? It's our building. Right?
We don't-
It's JDA, right?
We care.
We'll have a project to fail.
Well, if any properties in town go into foreclosure, it's generally bad.
But we have no financial.
Correct, we have application.
This is part of the presentation. And we're giving you clarity. Okay.
The point I was just trying to make is that it is conservative underwriting. Let's see, so it's the cash flow through the non-payment of property tax and then, relatively cheap financing. It enables a cash flow that can support the debt service of this highly leveraged asset, which provides the community with some of the middle income housing that we currently lack because we don't have another dedicated funding source for this type of housing. So the city does have an affordable housing fund. We receive those through various ways. There was the old redevelopment agency that had housing set aside money. That was when redevelopment went away, that became a housing fund for us. The state allowed us to keep that for affordable housing purposes only. We also have, through our community development block grant program, we receive home funds through the federal government for affordable housing. We also have a local housing trust fund, which is when the development community builds a brand new project, 10% of those units are required to be affordable, and they have an option to pay an in lieu fee. And so that in lieu fee money comes into our local housing trust fund. So those are some various sources of affordable housing funds that the city has, and we typically point those towards really restricted units, very, like, at the very low income level, the low income level, and we wouldn't want to use those for this sort of workforce housing level, which is only about a 10% reduction off of market rents. We usually say those for much more deeply discounted affordable units.
Well, and throughout the city, I think the Finance Commission, you can call approximately how many affordable units are included in our
In our
portfolio.
portfolio, it's over 2,000 units in our current housing portfolio.
Of what kind?
Various income levels. So just for affordable, some of those were done through on-site production from the development community. Some of those were leveraging some of these sources that I mentioned to you through other development projects. And that 2,000 does not include either of these projects. Next slide, please. Oh wait, no, sorry, that previous slide didn't come yet. Oh no, sorry, next slide. So we looked at a public benefit valuation, and it was really, what is this lost property tax revenue that the city, we would have seen over 35 years, which is the term of the bonds. And when we looked at that from a net present value calculation, it was a much smaller number because, the property tax money is not, over 35 years, is not 100% available to us today. It trickles in every year over time as property owners pay their property tax bill. So you have to think about it in that context. And then when you look at, well, what would it be if we had it all up front? And so you do a net present value calculation, and it quickly sort of changes like the value of what you think of it when you were just to calculate it all over time. You start to think about, oh, well, this property generates this much in year one, and you multiply that by 35. So you have to think about it, because that money is not all accessible to us today. And also that the cost per door, so if we look at sort of the total property tax abatement on a per door basis of these both projects combined, it was much less than more conventional affordable housing. And so, for example, the Jamboree project that I mentioned to you earlier, that has a much higher cost per door from the city, where we use some of those funding sources that I just mentioned to subsidize that. It's been a while, I recollect it's like around $70,000 per door, and that's just the city portion on that Jamboree project. And there's a bunch of other funding sources from the county, the state, that have gone into that project. So that the subsidy per door on that, now of course it's a much more deeply discounted project, so it's not really an apple to apples comparison, but in this particular case, gosh, I crunched those numbers so long ago, I want to say it was like 10,000 per door, so it was significantly less.
Can I ask how much per year the city would be foregoing the property taxes on this property?
The first year property tax forego amount that will be foregoing is about $370,000. And that again, increases over time based on property appreciation.
Isn't it 25 million though? I mean, using the net present cash flow model just to discount it, so that people go, well, it's really not that much money. That's just a great way to kind of pad the fact that we're losing 25 million bucks. Pure and simple.
In a moment, I'm going to talk about the future value of that money through kind of the real estate appreciation, but let me just see if I can finish this slide real quick. So kind of overall, this was a cost-effective way to achieve the public benefit, which is hard to really quantify the sort of public benefit of providing this housing type unit, this affordable housing in our community, because the proportionate share on a per door basis is relatively inexpensive to other housing unit types, and there's a huge investment opportunity, which I will get to on this next slide, please.
Ursula, you said that we currently have 2,000 units, and we're adding an additional 500, you said?
Between the two projects,
674.
Okay, and where do we come up with the number of what we need for city? How many low?
How many total units that we have?
We have an assessment that is done that looks at our kind of demographic breakdown, and it looks at income levels and different, how many people are unhoused and different things. So that is done every 8 years as part of our housing element update. It's a community profile, and that largely, from a local perspective, that information is helpful to understand what our housing needs.
So what was the number we came up with last night? That we
I'd have to go look at it. I wasn't here when that document was done. But I think that we can just kind of look around town and notice the number of homeless people that we see on the streets.
Can we
I
have homeless
think
people at the Elan Apartments?
a lot of the probably anecdotally when we talk to maybe people whose children are trying to, move back into town, maybe they've gone away to college, got their first job, decided they don't want to live in a big city anymore, they want to come home and have a family, how difficult it is to find housing. I think that it's probably not uncommon to have some of those kinds of conversations around town.
So I would say that would be came up with that number of what we wanted.
No, so like Ursula was describing, through every 8-year cycle, there's through the housing element, a prescribed number of affordable units that every community is supposed to produce. And that's based on your demographic profile, income levels, things that are happening within the community. The code portfolio that we have, 2,000 units of affordable housing, is really what we produced over time. Prior to redevelopment being eliminated, the city had much more consistent funding streams to invest in affordable housing projects. And I think what Ursula was trying to describe through the assessment, the public benefit assessment, was giving up, if we're going to give up $370,000 in property taxes, that's the city's contribution. If we were to move forward with the project, are we getting an appropriate number of an appropriate value back for that investment? And so for the two projects in question, like Ursula mentioned, we typically wouldn't at the staff level recommend using our restricted housing funds for middle income housing. Primary reason for that is it takes a lot of money then to achieve a smaller discount if you're investing in building a new project where rents are only maybe 10% below market rate. Typically, we invest those in permit supportive or low or very low projects, like the Jamboree project that's going to be built over at Beach and Ellis in early next year. So for this project, when you calculate everything out on a per unit cost basis, compare the two projects. The Jamboree project cost the city roughly $70,000, $80,000 a door, compared with this model. By foregoing the property tax, the value was roughly $10,000. The cost was roughly $10,000 per door. And so when you're looking at, we're getting this number of units that would be restricted at a rent basis, roughly 10% below market. Is there appropriate value there? Roughly speaking, we felt like yes, if you're looking at the calculation, there is some good value if you wanted to pursue this particular issue.
I still don't have an answer to the question. What was the number that we were required to have? And have we reached that number? Are we over that number? The 674 units, what does that do for that number?
Okay, so I guess I was trying to say, beyond what we were required to do, I think that there's an acknowledgement, at least at the city council level, that there's some, whether the state's telling us to do affordable housing or not, there's some public policy purpose to have a continuum of housing options. And so we look at some of the stuff in our community profile to kind of look at locally. But there wasn't a local decision to say, in these years, we want to produce these many units. So in the housing element, that is where this RENA process, you might be hearing about it if we're going through our new 6th cycle process right now. It's the regional housing allocation assessment process. That the state there does use a little bit of that local profile, but unfortunately they use a very complicated methodology that we don't really agree with to come up with a housing number and give it to all of the council of governments throughout the state of California, and split it out to the different jurisdictions within their area. So we, in the 5th cycle, which is the current cycle that's about to expire, we did get a number, I believe it was around 7,000 total. And then that's broken down into different income levels of the moderate, low, very low, extremely low. I don't know that breakdown off of the top of my head. That document is publicly available and anyone can go in and see what that is. In this current fifth cycle housing element, we have achieved all of those state thresholds in the market rate housing. So of those 7,000 units, a number of them are supposed to be market, and then it was the moderate, low, very low, extremely low. We've met all of the thresholds for the moderate and the market rate housing. We are short on the low and the very low. I don't recall by how much, but we're in deficit in those areas. So this particular program wasn't really done to help achieve those targets. We've already met those targets, but we still get anecdotal evidence that there is a need for workforce housing through this conversation with this employer, through conversations with people talking about their children. So this wasn't through a mandate from the state. It was for local policy purposes to create more workforce housing was the impetus to move it forward.
So this was the city council wanting to do this. They had no outside influence in having to do this stuff. This is just something that they had on.
Ultimately, it was a policy decision by the city council.
I can tell you, I'm a family business owner of a manufacturing company in Huntington Beach, and we have an extreme need for our people who can't live in Huntington Beach, and they travel very far for jobs.
A lot of people do.
Who cares? Well, a 10% reduction would not really make that much of a difference.
I traveled far for my job.
So, let's see, I think we were on the next slide is so the public equity opportunity. So the city will be able to create significant public equity through this program in a number of different ways. So starting with the property tax revenue, which we are not going to receive, but really it's being invested into these two real estate assets. And when you look at and we're not, when you look at your own personal finances, you're cash poor, any income you receive, you have to pay the bills. And so you don't really get to invest that money and to see it grow in other opportunities. The city right now is in good financial condition and we're not cash poor. We don't need this revenue to pay our bills. And so you look at how do we invest it. The city has very limited options in how we can invest our money, and it's in very low return investment opportunities. Like LAIF is the local agency investment fund, which historically has a clean cut 2 or 3% returns. And so when you look at taking that same money, so the property tax abatement over those 35 years, and now it's being invested in this real estate asset, which at the end of the term of the bond, or potentially even earlier than that, but it's waiting until the end of the bond, this property will transfer to the city, from the JPA to the city. The city will own this property and fee less any, so if it sells, and we have that option anytime after year 15, we can compel the sale of these properties. At years 15 through 35, there's still debt service that needs to be paid. We have to pay that off, but whatever's left over is for the city. And real estate has appreciated by much greater amounts than, say, that LAIF investment. So this was an opportunity not only to provide some public policy benefits to the city that we talked about through housing, economic development, but also to wisely invest our money into a way that will benefit the city in the future. So,
Oliver, is there a reason why cities typically invest in low return instruments? What are the reasons?
To harvest votes.
Safety.
This is good.
The way that our investment policies work and for government agencies, you're not chasing yield typically. It's safety first, but safety next, and yield comes last. So,
how does this purchase, this investment fit into that scheme of the city? The fiduciary duties of the city to safeguard the money there.
Within the portfolio of options that the city council has, certainly moving forward with this type of an overall program where we're foregoing property tax, in exchange for the eventual return of the property in question that will be acquired by a third party. Again, it's a policy discussion. Is it something we should do or shouldn't do? We'll leave it to each of you to come up with your own conclusion.
No, my question, you've been city manager for a number of cities. Is this normal for cities to invest in real
Yes,
estate?
in this type of format, yes. This is not unique, and it's not unique
To take on this type of risk?
this type of program, the middle income housing program. Now, what I will say is, thanks to Ursula and our team, we actually created a much more beneficial model for the city agency here than typically is run through this type of program. There's a couple of standard marketing tactics that are going on for a couple of companies where there's a lot more money extracted out of these deals for the developer at the front end. Ursula and the team, before we moved the call forward to the council, really created a unique partnership with different entities that had to naturally work together. The end result of all of this is it's a much more sustainable model, one that's much safer in that there isn't much money pulled out of the deal at the front end. Money is kept in the project on the back end. And ultimately, as it relates to, is this sort of groundbreaking? It's groundbreaking in that the format and structure of the deal we created is incredibly unique. It hasn't happened before when we did it here in Huntington. The model, though, it's been used widely up and down the state by multiple cities.
Recently, or just historic?
So what was the acquisition cost for
The
this?
last couple of years it's happened.
Last couple of years.
What city? San Francisco?
What city?
Oakland?
There's a
Vancouver?
Berkeley?
City Orange.
In the last few years, it's been down California and other states as well.
So it's a relatively new investment. We really have no track record of the safety of this investment. So the city is actually going out on a limb here for this. I mean, 2008 isn't that far back, right?
Right, correct. I wouldn't agree that the city's going out on a limb in that when we are going out on a limb for it, it's a very fixed number and it's a fixed investment. It's the annual property taxes that will be derived from the two projects. That's what the city is putting at risk, if you will. The net return, though, at the end of the deal is twofold. One, during the life of the deal, we create some middle income units. In our case, 670 plus middle income units.
Right.
Plus, at the end of the deal, the properties are reverted back to the city. Is that worth the investment and the risk? Again, our only risk because of the JPA model to the city is the property tax that we're foregoing. There's no other risk to the city outside of that. And so ultimately, that's the policy question before you.
So who's assuming the risk?
The joint power, the underwriters,
Who are they?
the Wall Street, the investment, the folks who purchase the bonds to raise the money to acquire the properties.
And I guess I would just add that, it wasn't that this whole kind of idea that there's a return on investment for the city, that's not what led this decision. It was just sort of a secondary benefit, ancillary benefit. So it was really these public policy decisions related to housing, economic development that led the interest to explore this program, understand it, and that was a extra kind of thing that helped, I think, make additional sense of it. So the city has potential for significant return on investment, which allows the future city council to make some interesting decisions. If pension obligation bonds are a problem in 35 years or 15 years, 20 years, there's these assets that could be sold for a significant amount of money to assist with that kind of a problem. If we're not in need of cash at that time, the project could be sold off, and those proceeds could be used for something else, maybe it's a fund, police and fire. It could also be maybe an affordable housing, a more traditional affordable housing developer like a Jamboree could partner with the city, and these could become more deeply restricted affordable units if that's the need. The point is that it allows for future decisions for the future city councils to make. That's like these
So real quick, you used police and fire and you used pension funds. I mean, let's face it, isn't the real driver like the special interest on these types of programs? Like, you're speculating there's future value on this asset. That's not unforeseen speculation. I work for a company that's sold their company for $2 million because they found at auction.com. All they do is sell foreclosed properties. CMBS loans, Wall Street gets it wrong all the time. You're going to leverage our future, to a certain extent, a small future, kind of like Robert Bob Citron did. Remember that? He went broke for Orange County as a trader. You know, this is all about special.
Yeah, but this is all for social justice nonsense.
I gotta jump in here. This isn't an open forum for questions or anything like that. We're here to get a presentation on this, for public comment on it. I respect the fact that you have thoughts on this. I think we need kind of reel this thing back and get back to the
Who's
presentation.
speaking? Because I don't have a voice.
This is our vice chair.
Sorry, I got here late. I didn't know.
So just quickly, the slide is to show who the partners were. So CMFA was mentioned earlier by Oliver, that's the JPA. Catalyst is the project sponsor, and Org was the bond counsel that looked at this.
Question. In January, you had a different partner than Catalyst.
CSCDA.
No, that was a.
We did a study session to review the options.
Yeah, but there was a different company involved. It wasn't Catalyst.
It was a different sponsor.
Yeah.
It was a different JPA and a different. Well, what happened is, as Oliver mentioned, when we dove into kind of the transactions that they had worked on, it didn't seem like necessarily such a great deal. There was a lot of money through that was given up front to the project sponsor. We were aware that that same JPA was working with multiple project sponsors in the same jurisdiction to bid on the same property, sort of driving up the cost of the property. We didn't like that. That doesn't make sense to drive up the cost of the property. So there were some things that we questioned, and
The transactional details on some of the initial models that, frankly, we all had some concerns about. How much the issuance costs were, how much the Twin Powers Authority was pulling out of the deal. Those are all concerns as we were reviewing the overall program portfolio.
right.
So through all of that, after the council had said, hey, let's look at this as a potential option, do some more research staff. Again, massive kudos to Ursula and her staff. We actually looked at multiple different possible structures for the deal. For this type of deal, and ultimately, this in the partner, CMFA Catalyst Org, it didn't exist before our team was able to pull them all together. CMFA is one of the larger issuers of bonds within the state of California. They do hundreds of transactions per year, but they have a public purpose benefit, which isn't just to make money off of the transactions. They're investing in building community. Catalyst was one of the asset managers that actually pioneered this type of use. We asked it, hey, we don't like municipal partners, can we pull together different groups of folks and structure the deal differently than it's been done traditionally? Between CMFA, Catalyst, Org, and Ursula's team, we were able to come up with actually a very unique framework for how a middle-income housing project can be executed.
And you said this initial meeting was in February?
I forget, it's early 2021, we had a study session with the city council where we had a group, CSCDA, presented their concept. At that point in time, the council looked at some other options and figured out is there a format under which this type of deal makes sense?
Do you have any idea how this project was at least suggested to the finance commission for any kind of finance study? That's 7 months ago.
This has been,
The first I heard about it was 2 months ago when Casey brought it.
this middle income housing project, it's been actually on the city council's work plan since January this year, and it's been discussed, at least 3 or 4 different settings.
I think we saw it in our April meeting when you presented with us with the city council's priorities for the year.
But we didn't really have a presentation on it, I guess.
You know, and
So we had no reason why we were just going to the details of this.
If I may on that point, I agree with you, Frank, that it would have been a great thing for the finance committee to look at, and that's the reason for the city task list that was proposed to the council earlier that you voted against. So I think we have a process in place to try to bring that in and marry the idea that you have right now. So, but I agree with you that it would have been a great opportunity for the finance committee to be aiding the council on this, to have a second pair of eyes, for lack of a better term. So that's just my 2 cents on that thought.
Well, I agree with you. I think this is why the Finance Commission, was kind of founded, is for projects just like this. And the fact that it was completely eliminated from our purview, I'm a little upset about it, being spending the time at the Finance Commission, that we weren't brought in on this at all. And we had to ask for it. Anyway, that's neither here nor there.
I will just quickly add about CMFA. One thing too, they take their fee and they split it. So 25% of it goes back to the city, and then another 25% goes to a nonprofit of the city's choosing. The other thing about CMFA, because they are such a large issuer of all types of different bonds, not just this particular program, they are willing to walk away from deals. So their underwriting is really strict, and that we like that about them as well, that if they didn't think that it made sense, they would, it wasn't a couple of the other JPAs, that's all they do is no income, and so they're really hungry for projects because that's how they're surviving. And so that was another thing about the CMFA. And then Catalyst is just, it's in their core DNA in terms of what their mission is this workforce housing. And in fact, the founder, talks about how he lives in an area where school teachers drive 3 hours to get to class, and he was like, I don't want my children going to school where their teachers have to drive 3 hours to get to school. And so he's really passionate about this topic. Next slide, please. So this, unfortunately, I didn't print. I'm not going to be able to read it from here, but so this is the Breakwater Project, and this is showing what the rent would be. There's 3 different tiers depending on your income level. So there's this 80% tier, the 100% tier, and the 120% tier. You can see based on the floor plans that they have. And in Breakwater in particular, this is an older asset, and so there's significant rehabilitation that will be happening as part of this project. So these units are going to get some new investment, they're going to be refreshed, and there's this mix of mostly 2 bedrooms, some 3 bedrooms, and you can see what the rents are. And for those who can't, I will kind of go over the cheapest rent at the 80% tier is $1,925, so almost $2,000 a month. And at the highest tier for a 3-bedroom at the 120%, it's $2,875. So I bring it up because a lot of people were like, this is slum housing, this is for, really like poor people. It's not. So the units are going to be reinvested into. They will be better than they are today. The project will look nicer than it does today. And these income levels are still by no means cheap. I mean, you still have to be able to, have a decent income in order to afford them. And then this is for the Elan project. These are the
Ursula, before we get off the Breakwater, I got a couple of questions because that's the only debt service document I got. Can I ask you a couple of questions on that?
You can, I probably won't be able to answer them, but I can always follow that.
The first question, there's 375 units in Breakwater. That's the math I did. I think there's 600, 400, 375, somewhere around there. I was looking at, for example, year 2024 on the debt service payment schedule, and between bonds A and bond B, there is, for that year, 2 payments each, right? That totals $7,409,500 for the year. If you break that down, it comes to about $1,500 per unit. Now, I asked an email, I guess I asked Dale, and he sent an email to you or so. I said, what happens to the excess on this? And the question, the return was, the excess flows are applied toward principal reduction. Right? That's the response I got from you.
Well,
On the email.
it was my analyst going to the underwriters.
Okay, so the excess flow is that where it's going, the principal reduction?
I don't have a reason to doubt their response.
Because I'm looking at 2024, And it says principal redemption, so I'm assuming is principal reduction, that's what we're looking at, right? Principal redemption, that's how much we're paying off the principal. Is that correct?
I'm not sure,
In
I'm not seeing what you're looking
the debt service payment schedule, there's a column that says
That's too dumb
principal
for this job.
redemption. In my business, we call it principal reduction, but is that the same thing, where we're paying down the principal?
We can check on that for you again.
It is, trust me, it is, I'm looking at the numbers, that's what it is. And there's also an interest
Is that a
payment.
rhetorical question?
Well, I just want this on record, okay? And then there's an interest payment, and the numbers I'm talking about is $7 million, $7,400,000. It's all interest payments. There's no reduction of the principal. Now, is it codified anywhere that the excess money is to go into principal reduction? Is it in any of the agreement at all? Is it written down and signed that says any excess money is going into principal reduction?
Frankly, again, this wasn't a city issued deal. This isn't the city's bond issuance, so we didn't get into the mechanics of nothing, but we can get the CMFA group here to answer your question.
Okay, well then here's another question. $1,500 a month is essentially what this debt payment is for 2024. I'm looking at, if you could go back to the previous slide, I'm looking at the minimum is $1,900 a month. So at the minimum, we got $400 a month per door excess. Where's that money going?
If the overall structure of the way the rents are working is that excess money needs to go into principal reduction, we can figure all of that out and have the underwriting firm and the APA folks come and explain that to the Finance Commission. Again, this isn't a city deal. What I will tell you though is, if it's 100% fully leased all the time, maybe that's what it looks like. But right now, the occupancy rates at both of the facilities are averaging somewhere in the 90% range.
I heard 95, that's the official number.
I don't know exactly what that is, but again, between the city is a partner is party to the Joint Powers Authority, but that's a separate entity. All of this is run by Catalyst and CMFA. So if you're interested in the specific deal terms, we can have the underwriting firm scheduled to come to a future meeting and describe sort of what it is that in the technical elements of the deal for you.
I'm surprised the city doesn't know what the numbers are.
That's a big mess.
Well, I'm not.
We can certainly find the information for you, Frank, but again, what's incredibly important for the Finance Commission to know, that this isn't a city deal. We're part of the Joint Powers Authority. The Joint Powers Authority and Catalyst are the ones that are running this deal. Pursuant to the terms, the top level numbers we're very familiar with. The details, we need to get some other folks from our staff to come and explain some of the nuances of what's included in the specific deal. We need the CMFA folks here also. We can facilitate that for you, Frank, if that's the Finance Commission to get into the mechanics of what the bond transaction look like. Typically, if it's a city issue deal, we're intimately familiar with all of the ins and outs of the actual transaction. But again, given that this is a transaction that the city is only part of through the JPA arrangement, this isn't a city issue at all. I've heard folks keep saying that the city is issuing $400 million of debt. We have the Joint Powers Authority has, the CMFA has, not the city. And so,
For the record, if this property goes upside down, the city has zero liability financially for this project.
correct.
Zero.
Correct.
Can I interject here? I think that we should let the city make their presentation and then have some questions.
This is part of the presentation. They're talking about money.
Yeah, but let them make their presentation first, and then we'll gather up questions and
Which is why I asked the question.
Ursula, almost finished. So,
I'm
next one.
gonna second with Robert on this, that what we're doing right now, we're talking about issuing and getting responses back from people in finance. That's a directive that needs to come from the commission as a whole, that requires us for a process to talk about the commissioner comment, agendize an item, discuss, and then issue something from there. My understanding of the bylaws of this commission is that the finance department is not here to work at the pleasure of a specific commissioner or commissioners. It's at the pleasure of the council, and that we work with them together. So we need to maintain that process going forward in this, and I would also concur that we do allow the folks over here to move through their presentations so we can, let them say their piece and express what they want to do.
For the record, I was not the one.
CJ,
For the
and
record.
Ursula, you don't have the floor right now. The floor is still.
So
Gosh, why can't he talk?
Are the events for the Elan project, and it's kind of very similar to the other one. I'll just go over. Oh
my God. She's so bad.
What?
What?
Studio, and the largest is a 4-bedroom.
She thinks she's real
And
powerful.
so the least expensive rent at the 80% tier on the studio is $1,750, and then the most expensive rent on the largest unit at the 120% tier is $2,825. Again, this is just to give you an understanding of what the rents are. This is a newer project, so there's not as much money going into renovation, but there was some set aside to go in and do some updates. And then this last chart just shows maximum income by household size to give you an understanding of the folks who would qualify for this program. So it's based on household size, so 1 versus 7, and at the different tiers. And so if you are a 1-person household.
Thank you, Mr. Lograsso. You're the only person here that's not a freaking idiot.
Tier, you would need to make $75,360 a year. So I think that is in line with a lot of, people, I mean, I guess my children graduate from college, their first job, they're making $75,000 a year, I will be happy. So it, I think it gives you a sense for the folks that we're targeting here through this program. And then at the high end, if you're a 7-person household, you can make up to $200,000 per year at the just gives you an idea of the income levels, and that includes the presentation. We're available for any questions.
Thank you so
I'd
much.
like to be recognized, please.
Thank you,
For the
Frank.
record, I am not the first to question anybody come in here and give us more information. That was something that our city manager suggested after the questions I asked could not be answered. So CJ, I'm not the one asking for yet another presentation.
This
I was just
question is
asking
for the
questions.
panelists, or is this a commissioner comments? Because that's for the end of this, right?
I just had the floor, and I just wanted to clarify what you had just commented on there, CJ.
Great, thank you.
All right, well, let's move on to commissioner items. Do you have anything else, Frank?
Yeah, I do. I would like to know, Chairman, the reasons why a finance commission meeting should be canceled. Do we have any kind of clear definition of the cancellation of meetings? What would drive a cancellation?
We didn't have somebody speak that was.
Well, we did have agenda items. We had 2 agenda items other than having Oliver here. The first agenda item was we had.
I would have been happy to talk to you. I didn't get an email from you.
Well, because we canceled the meeting. There was no discussion had. We had minutes from the previous meeting that we could have discussed, and we also had comments from the public. Those are 2 things that were on the agenda that we could have had for that meeting 6 weeks ago. So my question is, the cancellation of these meetings, is this driven by staff, or is it driven by a committee, a commission? Who's responsible for not just scheduling
We
meeting
don't have
canceling?
anything formally documented. You should know you were.
It says in the documentation that these meetings should be held on the 3rd Wednesday of the month. I understand that not having a quorum will cancel a meeting. I also understand that there's special circumstances like a pandemic that'll cancel meetings. The fact that a speaker's not showing up, I don't know if that's on the list of things that was included in canceling meetings.
Okay, well, let's talk about this as a commission.
Mm-hmm.
Do we want to come up with some formal rules as to when we cancel a meeting and when we keep a meeting when speakers aren't present?
Let me just chime in on that. If we're talking about amending bylaws, which I think this would trigger, there's a lot more process in place probably than just, coming up on the fly and sitting down and talking about what we think are the proper grounds for a continuation or cancellation of the meeting. I think we probably need to formalize at this point an agenda item to discuss whether or not we want to propose a proposal for change to the bylaws or an addition of some sort on that in order to maintain the proper procedure. It's certainly a conversation worth having. If there's concerns by commissioners, Frank, I understand your concerns. I think the ambiguity that's there is something that should be addressed so it doesn't happen again. Every time that there's a problem, there's an opportunity for us to come up with a solution. That's not a bad thing. But I think if Frank, if you wanted to make a motion to agendize an item to discuss something with the bylaws, I would second it. For the obvious reason that we possibly eliminate a problem in the future.
Yeah, I think we need to have something in writing on how these meetings are not just initiated, but how they're canceled. And like I said, I know the two reasons.
That's a fine discussion to have, and I agree with you that being formally documented and laid out is something that would be in everybody's best interest. So I don't think that there's an issue with that. So that's my 2 cents on the issue I think that Frank's presenting.
Let me move that we agendize next month a discussion on the procedures for canceling a scheduled meeting. The appropriate.
If it's an issue of whether or not the finance committee can discuss whether or not an amendment to the bylaw is merited or necessary in order to define this specific issue and problem. That is where I think that the proper fence needs to be on this point so it doesn't pop up again.
Say that, repeat that one more time.
I love it. The thought escapes me as soon as I just say it.
Yeah.
The proper fencing on this needs to be whether or not the finance committee can make a proposal to an amendment to the bylaws to remove any ambiguity or to further define how a meeting can or should be canceled and what that protocol would be or requirements would be.
So you think the first step should be the question, can we amend the bylaws?
Can we amend the bylaws? That's absolutely the first question because we're dictated, we are absolutely controlled by those bylaws. That's the first question. If we can't amend it, then it's not up to us to make a decision about whether or not we can define how.
Who would have that answer?
What's that?
Who would have that answer?
Okay.
Who would have it? Who do we talk to with that?
I don't know, Frank, why do you agendize it? We'll talk about it.
We're going to talk about something that we have, nobody's got any idea of.
I'm going to have a conversation about an item that needs to be discussed. That's agendized.
Right. What's the current bylaw on
We're in the
cancellation?
office right now.
There's provisions in the municipal code and there's a handbook that sort of governs how we're supposed to operate. I think the meeting was canceled last time because outside of minutes, there was that we didn't have folks available to address the only agenda discussion topic.
But it's not the only agenda, that's my point. You always have an agenda item. And that is the approval of the minutes. And discussion from the public. Those are 2 items that are always on the agenda. So we're never without an item on the agenda. If we don't have a quorum, we can't meet. I totally understand. If we have a pandemic and this place is shut down, I completely understand that. I did not understand why we canceled our meeting 6 weeks ago, and I think we need to have the discussion.
What does the bylaw state?
I just made a motion that I want to discuss that. And
CJ, did you second his motion?
I didn't because it wasn't, because his proposal, my proposal were not agreement. So I'm not, it needs to be further and properly defined in terms of what the agenda item is for discussion, or I won't second it. That's why I made my kind of definition. So, Frank,
for clarity, Frank, where is the bylaw on cancellation at?
Fair enough.
I missed that, what? Sorry?
I don't agree with this. I think it's going down the wrong path. If we, I think the commissioner, Stephanie, as the chairperson, she can, cancel a meeting if she feels that it wasn't going to be productive and it was only the minutes to do stuff.
Well, if that's the case, then we should probably memorialize that, don't you think? That that the chairman can cancel a meeting, period.
Because the item that was on our agenda couldn't be discussed.
But there was other items on the agenda.
I understand what you're saying.
And if we want to put that power in the chairman's hands, that's fine. I just think it needs to be spelled out. That, you know.
I don't think that this is power.
Well,
We just-
I didn't
we're-
cancel
we're-
it.
we're discussing it right
I
now.
don't want to go to a meeting that just, agree with the minutes and say that's it. I mean, I would like something substantial or something that needs to be discussed. And if Stephanie thought that it wasn't, urgent, and we were gonna wait till Olive was available, I don't have a problem with that.
I agree, I don't have a problem with that.
Well, in this case, would you have a problem with a discussion that should have taken place before, I don't know, a council vote, but then the meeting was canceled until after the council vote? And we weren't able to weigh in on it. Would that be a problem?
No, I'll address that in my commissioner comments. I have some thoughts about that.
Because that's my point, is that the delay of a month could be big. It could be, it could be keeping us from bringing an opinion on something that hadn't been voted on, but, the next month, there's 2 city council meetings, maybe it's voted on then. So.
Well, that's a great point.
Well, Frank, when you wrap up your commissioner comments, then I'll comment to something that is aspect.
And if maybe, if it's okay for me to offer a staff perspective, I do think the Finance Commission, we've been tackling a lot of issues that have already been decided by the City Council. Even when this meeting was canceled 6 weeks ago, the program had already been approved, the Middle Income Housing Program. And if it's the desire of the Finance Commission to be more embedded into current issues that are being deliberated by the City Council, there is the committee task list process to try to get some of the opinions from this group to the council prior to making a decision. That's certainly, I think, within the Finance Commission's purview, but Craig, I think even 6 weeks ago, they should have already been voted on.
How long is that task force committee?
So, Craig, I don't remember exactly, I think it was the first quarter of this year-ish when the Finance Commission transmitted that to the City Council.
That didn't work. With this particular item, did it?
And at this point, what I would suggest is the Finance Commission, or Frank, if you feel like you'd like to get involved in issues prior to the council voting on something, the Middle Income Housing Program, again, had already been decided, but when we're bringing them, sort of an overview now, but the decision has been made, the issue's been voted on by the council. If the desire is to get out ahead of issues, and certainly each of you have relationships with your appointing council member. Also, as issues are coming up, if there are issues you'd like us to ask the council, whether or not they want the Finance Commission's input on through the CTL process that's been developed, please feel free to let Dale or Sunny know or me know. We're happy to ask the questions to the City Council. One issue the council did recently make a decision on to ask the Finance Commission to review is our design, build, finance, operate, maintain proposal that we're looking at. So we're working through a process right now with the council subcommittee. We'll be bringing that back to this group for review. That DBFOM process involves a different way of looking at maintenance of new city facilities that are to be constructed. We have 3 major projects that we're currently considering. The police department, the civic center, Lake Fire Station, all are in need of significant upgrades. Is there a better way to coordinate the future maintenance? So we'll have our public works team come and provide an overview of what we're thinking, and that is getting out ahead of the issue. If there are other issues like that this group's interested in, again, we did present the Finance Commission with the council's strategic priority list. If there's any of those issues you feel like you'd like this group to weigh in on before the council's making that determination, again, please let me know or Sunny or Dale know, and we'll be happy to pass that message on to the council and see if it's something we can get before everybody. I hate to see some of the conflict with the board, with the commission over a nuance. And I understand why you're frustrated, Frank, over a meeting being missed, but if the desire is to have the commission weigh in prior to issues being decided by the city council, I think there's probably a more productive way for the commission to be interfacing. So I'd offer that, and if that's something you'd like us to pursue, staff's happy to help facilitate.
Yeah, that's fine. So, would you know who you would talk about being able to update the bylaws? Is it the city attorney?
The city, ultimately, the bylaws for the finance commission are codified in the municipal code. That means that any change has to be made via ordinance by the city council.
All right, we have more commissioner comments. Can Ron, would you like to speak?
Yeah, I'd like to speak. Okay, so my comments are, look, I understand about this project. I understand that, the train left the station. It was a public policy decision by the council. I wish that they had come to the finance commission beforehand. Finance commission found out about it by accident, but it was Casey. And I understand that the decision was already made. I understand that the city doesn't have much involvement in it. But in the future, I think that if we're going to be of value, that when the city is, say, deciding on whether it should sell city property or, like Alvin said, the maintenance, going through that, or maybe even the sale of school sites to develop it and how that would impact the city, that would hopefully come to the finance commission first before the city council has decided to do their thing, and then, maybe we can make an impact. That's really what I'm hoping. And then, Alvin, you know what's going on in the city. Maybe, you could say, hey, let's weigh in, let's give this to the finance commission and let's weigh in on it. I understand that this is a weird time with Zoom meetings and, meetings get canceled and things like that. But really, we're not going to be combative here. We just want to understand it and watch out for the city. So that's my comment.
Thank you.
I just have some final comments on this. This will be actually, not to go out with any fireworks, but this will be my last day meeting with the finance committee. I am going to the charter review committee after this. That will be convened starting soon here in the future. So rest assured, it was vetted with the city clerk and everything like that to make sure that my attendance to this meeting was proper, given that I'm moving to that charter review commission. I want to say this, is that I have thoroughly enjoyed, even in the more heated discussions that we've had, speaking with every single one of you. I have the utmost respect for all of you because of the fact that you take time out of your days to lend your time to try to make the city better, to just try to lend your hand and try to carry some weight. To city staff that conducts these meetings, you guys are outstanding. The amount of time that it takes to make this process all work, even on this smaller subcommittee level, so to speak, is really commendable for how much time that it all takes. There are other people on this committee that I know would probably be in line for vice and chair coming up here, and I can say that they are extremely capable people. I am excited about those people having a chance to lead this committee going on in the future. And at this point right now, I'm just very thankful for the opportunity and experience to work with all of you, and thank you very much.
Thank you, CJ. Thank you so much for serving on the committee with us. We've really enjoyed it as well.
Cool. Thank you. Thank you.
Good luck to you.
You guys do. Well, hey, I just say margarita Tuesday now. That's happen another time. That's a joke that I'll make. So anyway, but thank you everybody. It's really been a pleasure.
All right. Well, thank you so much to everyone who came and spoke, to Ursula, to Oliver, and this meeting will be adjourned at 6:30.
Recording stopped.